Before making any investment decision, as investors, we analyze the product. We analyze different criteria like safety, liquidity, and returns. Some instruments, you know the interest rate beforehand, like bank FDs, post office small savings schemes. When it comes to insurance policies, especially traditional policies, you need to figure out the potential return of the policy before investing. Here comes an Excel function IRR, which will help in calculating the returns. In this video, let us calculate returns for endowment policies and money back policies. Welcome to holisticinvestment.in. First, let us look at the Excel function IRR. The IRR function is categorized under Excel financial functions. The internal rate of return is the interest rate of investment consisting of payments, that is negative values, and income, positive values, that occur at regular periods. These cash flows do not have to be even, that is, the amount whatever you pay or receive need not to be the same. However, the cash flow must occur at regular intervals such as monthly or annually. For example, we pay insurance policy premium at regular intervals, say at the beginning of each policy year. One more point to be noted, you need to enter the value in negative whenever you pay out of your pockets and all the receipts in positive sign. Now let's do some number crunching. First, we have chosen LIC Dhanvriddhi. It is a single premium policy. The premium amount is 8,96,715. The policy term is 15 years. At the end of 15 years, you would be receiving 21,25,000. So in the first year, we enter 8,96,715 with a negative symbol followed by zeros for the next 14 years. After the completion of premium paying term, you will receive a maturity of 21,25,000. We shall enter that amount and then we calculate interest using the formula IRR. Type is equal to IRR, open bracket, and select the cash flow, close bracket, and enter. The IRR is 5.92%. Next, we shall move on to LIC Jeevan Labh. This is a limited premium paying policy and a participating policy where you receive bonus based on the profit declared each year. So we can work out the potential return of the policy under two scenarios. Scenario 1 at 4% and scenario 2 at 8%. The annual premium is 9,134. We enter this with a negative symbol. The premium paying term is 16 years. The policy term is 25 years. Enter 0 after the premium paying term. The same applies for scenario 2. Finally, you receive 2,20,000 under scenario 1 and 3,70,000 under scenario 2. Fill in that amount. Now let us calculate IRR. Type is equal to IRR, open bracket, select the cash flow and close bracket and enter. The IRR under scenario 1 is 2.33% and under scenario 2 is 5.28%. Next, we shall move on to the money back policy, LIC Shriram Money. Here you receive money back at regular interval and final maturity at the end of the term along with guaranteed addition. The annualized premium is 10,75,550 and the premium paying term is 10 years. Let us fill in that first. Please remember to use negative symbol. On 10th year, you receive 30% of basic sum assured. Here, it is 30 lakhs, 30% on 1 crore sum assured. Along with that premium amount, enter this receipt with the plus symbol. Put 0 in the 11th year as you will neither pay nor receive any benefits. Again in the 12th year you receive 30% of basic sum assured, which is 30 lakhs. 13th year again 0. 14th year you receive 40% of sum assured along with guaranteed additions. Now let us work out guaranteed addition. For the first 5 years, rupees 50 per 1000 sum assured. So 50 divided by 1000 into 1 crore into 5 years. In the next 5 years, rupees 55 per 1000 sum assured. So is equal to 55 by 1000 into 1 crore into 5 years. So the total guaranteed addition is 52 lakhs 50,000. 40% of sum assured is 40 lakhs plus guaranteed addition 52.50. Now let us calculate IRR. Is equal to IRR, open bracket, select cash flow, close bracket and enter. The IRR is 4.80%. This IRR calculation can be used to assess any investment avenue. Here we have shown only some reference. This could be applied to figure out the interest rate of any product. If you get a hang of it, you need not to inquire the details from a sales agent. You yourself can browse the details of the plan either from the net or from the sales brochure, and you can work out the internal rate of return. One more point to be noted: if your receipts from the investments are taxable, please use the post-tax value. An ideal investment return should be greater than the inflation rate. So take wise investment decisions based on your IRR calculation. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.